If you are in the United States, Europe, the Middle East, Asia, or anywhere else in the world, there is something you seriously need to listen to right now. What we are witnessing in silver is not a normal price move, not a routine correction, and not just another cycle playing out on charts. This is a signal, a warning signal, the kind that usually appears before most people realize what is actually breaking underneath the surface. On screens, silver looks weak. On paper, it looks like sellers are in control. But beneath that paper price, the structure holding this market together is under growing stress. Before we go any further, if you're getting value from this video, make sure you subscribe to the channel and turn on notifications so you don't miss what's coming next. And drop a comment below. Let me know where in the world you're watching from and what time it is there right now. I always like seeing how global this audience really is. Paper silver has become detached from physical reality. Futures contracts, unallocated positions, synthetic exposure, and leveraged bets are being dumped in volume, creating the illusion of abundance. But paper selling does not mean physical silver is suddenly flooding the world. It simply means claims on silver are being traded aggressively, often by players who never intend to take delivery. The price you see is being shaped by leverage, not by metal changing hands. This matters because the silver market is built on confidence in settlement. As long as participants believe paper promises can be honored, the system functions. The moment that confidence weakens, everything changes. And right now, cracks are forming. Open interest remains high even as prices fall. Volatility spikes without corresponding physical supply increases. These are classic signs of stress, not strength. For traders, this environment is dangerous because it invites false conclusions. A falling price normally signals excess supply. But here, the selling pressure is coming from paper instruments, not from miners, refiners, or physical holders rushing to liquidate. When paper overwhelms price discovery, charts stop reflecting reality. That is when technical signals lose reliability and traps get set. For silver owners, this phase is designed to test conviction. Weak hands are shaken out through fear, confusion, and fatigue. The message being broadcast is simple. Silver is failing. History shows this message almost always appears before structural shifts. Real holders are pushed to question themselves while the underlying imbalance quietly grows worse. What makes this moment critical is scale. The paper-silver market has expanded far beyond the amount of physical metal that can realistically support it. That imbalance works fine in calm conditions. Under stress, it becomes unstable. If even a small percentage of paper holders demand real metal, the system is forced to reveal its limits. That is the risk no price chart can show you. This is not about predicting an immediate breakout or calling a specific price. It is about understanding the signal being sent. When paper selling accelerates while physical markets remain tight, it is not a sign of weakness in silver. It is a sign of weakness in the structure used to price it. The louder the paper market screams, the more pressure it puts on the foundation. Across regions, from Western financial centers to Eastern physical hubs, this disconnect is becoming harder to ignore. Paper dominance keeps prices suppressed, but it cannot create metal. It cannot solve supply constraints. It can only delay recognition. And delays are what make eventual adjustments more violent. The collapse signal is not the price itself. It is the behavior of the system. It is the widening gap between financial instruments and real-world availability. It is the increasing effort required to push silver down despite ongoing demand. Those are not signs of control. They are signs of strain. This is why this moment deserves attention from anyone involved in silver, whether you trade it, hold it, or depend on it for business. Paper silver is flashing a warning. Not because it is winning, but because it is being forced to work harder than ever to maintain the illusion of balance. When systems start straining like this, outcomes stop being orderly. That is the signal. And ignoring it has never ended well. The current silver market is entering a phase that is especially dangerous for traders, not because volatility is high, but because volatility is being engineered in a way that distorts normal decision-making. What looks like opportunity on the surface is increasingly a trap underneath. Sudden price drops, sharp intraday reversals, and aggressive moves through key technical levels are not random events. They are signals that the market is being pushed into extremes where emotion replaces logic. In this environment, traditional technical analysis becomes less reliable. Support levels break without follow-through, resistance zones fail to hold, and indicators give conflicting signals. This creates confusion, and confusion is exactly what traps traders. When price action no longer reflects genuine supply and demand, the market stops rewarding discipline and starts punishing it. Traders who rely solely on patterns and indicators risk being pulled into moves that reverse Before positions can be managed properly, one of the biggest dangers right now is the illusion of confirmation. A strong move down convinces traders that momentum is real, inviting short positions. Then, without warning, the market snaps back violently, forcing stop-outs or panic exits. The same happens on the upside. Breakouts appear convincing, volume increases, and entries feel justified, only for price to roll over and collapse again. This back-and-forth action is designed to exhaust capital and confidence. Leverage magnifies this problem. In highly manipulated volatility, leverage does not increase opportunity. It increases vulnerability. Even correct directional calls can fail if timing is off by hours or minutes. Small moves become large losses, and risk management rules that work in normal markets stop working when price is being pushed deliberately through known liquidity zones. The market is fishing for stops, and heavily leveraged traders are the easiest targets. Another critical issue is time compression. Moves that would normally take weeks are happening in days or even hours. This accelerates decision-making and reduces the margin for error. Traders are forced to react instead of plan. Reaction leads to overtrading, revenge trading, and emotional exposure. Once discipline breaks, the trap is already sprung. What makes this phase particularly dangerous is that it feels familiar. Traders have seen volatility before. They believe experience will protect them. But this is not ordinary volatility driven by news or macro shifts. This is structural volatility, created by the imbalance between paper positioning and real-world constraints. When that imbalance grows, price becomes a tool rather than a reflection. There is also a psychological element at play. Repeated losses condition traders to lower position size or step aside just as conditions begin to change. Others double down, convinced that the next trade will fix the damage. Both responses serve the same outcome: capital destruction. Markets that behave like this are not designed to reward participation, they are designed to filter participants. For professional traders, the warning is subtle but serious. Liquidity is uneven. Slippage increases during fast moves, spreads widen without notice. These are signs that normal market functioning is under strain. When exits become unpredictable, even skilled traders face elevated risk. This does not mean traders should abandon silver entirely. It means the approach must change. Survival matters more than precision. Preserving capital becomes more important than capturing moves. When volatility becomes hostile, restraint is a strategy. The volatility trap works by exploiting confidence. It invites action, then punishes it, recognizing that dynamic is the first step in avoiding it. The traders who survive phases like this are not the ones who trade the most, but the ones who understand when the market is no longer offering fair risk. Right now, silver is flashing that warning clearly. While most attention stays locked on spot prices and futures charts, the real story in silver is unfolding in the physical market, where bullion dealers, wholesalers, and shop owners operate every day. This side of the market does not move on speculation or sentiment. It moves on availability, replacement cost, and delivery risk. Right now, those signals are quietly but clearly diverging from what screens are showing, and that divergence is where the truth is leaking out. Premiums are not noise. They are the market speaking honestly when price mechanisms fail. When the quoted price of silver falls, but the cost to acquire physical metal does not fall with it, or falls only slightly, something is wrong with the pricing structure. Dealers are not raising premiums out of greed or convenience. They raise them because the risk of replacing inventory has increased. When supply chains become unpredictable, the cost of certainty rises. For shop owners, this creates a dangerous illusion. Customers see lower prices online and assume inventory is cheaper. In reality, the cost to restock that same inventory may already be higher or uncertain. The gap between what customers think silver costs and what it actually costs to replace is where businesses get hurt. Selling aggressively into falling paper prices can leave shelves empty later, with no affordable way to refill them. Premium behavior also exposes where real demand exists. Paper markets can suppress prices indefinitely as long as trades settle in cash. Physical markets cannot fake delivery. When demand remains steady or increases while supply tightens, premiums respond. They rise not because demand is exploding, but because supply is no longer flexible. That rigidity is a stress signal, not a trend. Across different regions, this pattern repeats. One market shows shortages in small bars, another sees delays on larger formats, another experiences inconsistent delivery times. These are not headlines, but they matter more than headlines. Physical markets break quietly before they break loudly. By the time shortages become public, the adjustment has already begun. For bullion businesses, risk is no longer just about price direction. It is about timing and replacement. A shop that sells today based on screen prices is making a bet that tomorrow's supply will be available at similar terms. That bet is becoming riskier. Wholesalers adjust quietly, rationing supply or altering terms. Those adjustments show up first in premiums, not in spot prices. Premiums also reveal who has leverage. When buyers accept higher premiums without resistance, it means alternatives are limited. That tells you paper price is losing authority over real transactions. In those moments, the quoted price becomes a reference point, not a clearing mechanism. The real price is whatever clears physical inventory. This environment forces businesses to rethink strategy. Volume-based models struggle when replacement risk rises. Inventory management becomes more important than turnover. The goal shifts from maximizing sales to ensuring continuity. Those who ignore premium signals often discover too late that liquidity on screen does not translate into liquidity in hand. What makes this phase dangerous is that it feels temporary. Many assume premiums will normalize once volatility passes. Sometimes they do. But when premiums persist despite falling prices, it usually means structural tension exists. That tension does not resolve smoothly. It resolves through adjustment, either in price, availability, or both. For anyone in the bullion trade, premiums are no longer a secondary detail. They are the primary signal. They tell you where pressure is building, where risk is hiding, and where the official price is failing. Ignoring them is equivalent to navigating blind. The physical market is speaking. It always does before the charts catch up. The stress in the physical silver market is not loud, dramatic, or headline-driven. It is quiet, uneven, and easy to dismiss if you are not directly involved in sourcing metal. That is exactly why it is dangerous. Physical stress does not announce itself all at once. It shows up as delays here, allocation limits there, changing terms, and sudden unavailability of products that were easy to obtain just weeks earlier. Individually, these signs seem manageable. Together, they form a pattern that signals something deeper is tightening. Unlike paper markets, physical silver cannot be created with a keystroke. Every bar, coin, and industrial unit must be mined, refined, transported, and delivered. When pressure builds anywhere along that chain, flexibility disappears. What makes the current moment different is that stress is not concentrated in one product or one region. It is fragmented. Some formats are tight, while others remain available. Some suppliers deliver on time, while others quietly push dates back. This fragmentation hides the problem from outsiders, while amplifying risk for those inside the system. For silver owners and businesses, the danger lies in assuming availability equals abundance. Metal on offer today does not guarantee metal tomorrow under the same conditions. Supply chains operate on expectations. When refiners, mints, or wholesalers become uncertain about future input costs or delivery reliability, they slow distribution. That slowdown is not panic, it is risk management. But the cumulative effect is reduced flow, even if demand has not visibly surged. Industrial demand adds another layer of strain. Silver is not just an investment asset, it is a critical input. When industrial buyers secure supply, they do not advertise it. They lock contracts quietly and remove metal from circulation. That metal does not return to the market when prices dip, it is consumed. This creates a one-way drain that paper markets cannot reflect accurately. Charts do not show metal that has already been committed. The physical stress becomes most obvious during moments of price weakness. Normally, lower prices should loosen supply. Instead, we are seeing hesitation. Sellers are less willing to part with inventory. Buyers are more selective, but persistent. This tells you the issue is not price sensitivity. It is uncertainty. When participants are unsure they can replace what they sell, they hold back. That behavior tightens supply regardless of price. This environment creates asymmetric risk. If prices fall further, physical availability does not necessarily improve. If prices rise suddenly, availability can vanish. That asymmetry is what makes physical stress so dangerous. It does not move gradually. It shifts abruptly once a threshold is crossed. The most important thing to understand is that physical stress rarely resolves itself quietly. It builds under the surface while attention remains elsewhere. By the time it becomes obvious, options are limited. Lead times extend, costs jump, and access becomes conditional. Those who recognize the signs early adjust calmly. Those who ignored them are forced to react. The hidden stress in physical silver is not about fear or hype. It is about constraints quietly tightening in a system that depends on smooth flow. When that flow slows, price is the last thing to respond. Availability reacts first. And right now, availability is no longer as flexible as it appears. The risk surrounding silver is no longer confined to traders or investors. It has moved into the realm of national strategy, industrial security, and long-term planning. When a metal becomes essential to energy systems, technology infrastructure, and defense applications, its supply stability stops being a market issue and becomes a strategic concern. Silver has quietly crossed that line, and many governments are now responding in ways that are not visible on public price charts. Across the world, silver is embedded in critical supply chains. It is a key component in solar panels, advanced electronics, medical equipment, and military technologies. These sectors cannot simply substitute silver without sacrificing efficiency or reliability. That dependence means any disruption in supply has consequences that extend far beyond price volatility. It affects production timelines, national energy goals, and technological competitiveness. What makes this situation unique is the mismatch between public market signals and strategic behavior. On the surface, falling prices suggest abundance. Behind the scenes, strategic buyers act differently. Governments and state-aligned industries do not chase headlines or short-term price moves. They focus on securing supply continuity. When they sense vulnerability in supply chains, they move quietly, often through long-term contracts, stockpiling, or indirect accumulation. These actions reduce available supply without drawing attention. This quiet accumulation creates a paradox. Prices remain subdued while availability tightens. Market participants who rely solely on price signals miss the shift, but strategic planners do not. They understand that price is only one variable, and often the least reliable one during periods of structural stress. When supply certainty becomes the priority, price sensitivity decreases. Geopolitical fragmentation adds urgency to this behavior. As trade relationships become less predictable and supply chains more regionalized, reliance on open global markets weakens. Nations seek control over critical materials to reduce vulnerability. Silver, due to its dual monetary and industrial nature, sits at a sensitive intersection. It is both a store of value and a functional necessity. That combination elevates its importance in times of uncertainty. Another factor is time. Strategic planning operates on multi-year horizons. Governments do not wait for shortages to become visible. They act when early indicators appear. Those indicators include rising premiums, delivery delays, and uneven availability. These are not dramatic events, but they are meaningful signals for institutions tasked with risk mitigation. By the time public narratives catch up, positioning is already underway. The warning to nations is not about immediate crisis. It is about exposure. A system that prices silver primarily through financial instruments while relying on uninterrupted physical supply is inherently fragile. When strategic demand increases quietly, that fragility grows. Adjustments then occur suddenly rather than smoothly. For markets, this creates a blind spot. Strategic accumulation does not show up as speculative demand. It does not create volume spikes or price breakouts. It drains supply steadily. When that drain intersects with any disruption, the response can be abrupt. Silver's role has evolved. It is no longer just another commodity responding to cycles. It is a strategic material whose importance is rising as global systems become more complex and less stable. Nations that recognize this early gain flexibility. Those that do not are forced to react later under pressure. That is the warning embedded in the current market, and it extends far beyond price charts. The final red alert is not about fear, predictions, or dramatic forecasts. It is about awareness and responsibility at a moment when the rules are quietly changing. Silver is sending a message, but it is not the kind that shows up as a single price spike or a clean headline. It is a layered warning, different for each participant in the market, yet connected by the same underlying reality. The system is under strain, and decisions made during this phase will matter far more than usual. For traders, this is a moment to reassess intent. Markets like this tempt constant action. Every move looks tradable, every swing feels like an opportunity. But when volatility is distorted and liquidity behaves unpredictably, activity itself becomes the risk. The red alert here is not telling traders to be brave or aggressive. It is telling them to survive. Capital preservation, patience, and restraint become competitive advantages. The trader who avoids unnecessary exposure during unstable conditions often outperforms the one who tries to extract precision from chaos. For silver owners, the warning is psychological. This phase is designed to test belief. Extended weakness, negative sentiment, and constant doubt wear people down over time. That erosion is intentional. Markets rarely take metal from strong hands with force. They take it through exhaustion. The red alert for holders is to recognize that emotional pressure is part of the process. Decisions made out of frustration or fear tend to benefit the system, not the individual. Understanding why that pressure exists helps neutralize it. For bullion businesses and shop owners, the alert is operational. The risk is no longer limited to margin or turnover. It has shifted to continuity. Inventory decisions now carry more weight because replacement conditions are uncertain. Selling aggressively into a paper-driven price decline can create future vulnerability. The red alert is a reminder that survival in this phase depends on balancing sales with security. Staying in business through instability often matters more than maximizing short-term volume. What connects all three groups is timing. This is not a call to act impulsively or to assume an immediate outcome. It is a call to recognize that the environment has changed. When systems enter stressed conditions, outcomes become nonlinear. Small triggers can produce large reactions. Calm periods can end suddenly. Those who understand this adjust expectations. They stop demanding certainty and start managing exposure. Another critical element of this final warning is mindset. In stable markets, confidence is rewarded. In unstable markets, humility is. Accepting that not everything can be predicted reduces the urge to force decisions. The red alert is not shouting that something will happen tomorrow. It is stating that the margin for error is shrinking. When margins shrink, discipline becomes essential. This moment also highlights the difference between noise and signal. Daily price moves, headlines, and commentary create constant distraction. The real signal lies in behavior, how participants respond under pressure, how liquidity behaves during stress, how physical markets diverge from financial ones. Paying attention to those behaviors provides clarity when narratives do not. Ultimately, the final red alert is about positioning yourself mentally and structurally for outcomes that may not be orderly. Traders prepare by reducing vulnerability. Owners prepare by strengthening conviction. Businesses prepare by protecting access and flexibility. None of these actions require panic. They require awareness. Silver has always played this role during periods of transition. It exposes weakness not through collapse, but through tension. Right now, that tension is visible to those willing to look beyond price. The warning is not meant to scare. It is meant to wake people up before decisions are forced upon them. Those who hear it early have choices. Those who ignore it usually lose them.